Hello, we'd like to welcome you to our latest client update call. Today we have a repeat guest, Nick Lacey, who is the Chief Portfolio Strategist for Asset Management Services at Raymond James. We work with them very closely, and a lot of our clients are invested in portfolios that they put together. Nick has been on every year for the past couple of years, kind of giving us a picture of what's ahead for the coming year. So we look forward to hearing your updated comments today, Nick. Welcome.
Well, look, I appreciate you asking me to come on again. Once is a lot, more than once is exceptional. So I'm very grateful for that. I will do three things. I'll give you an idea of some of the things that we see as drivers right now, what are likely to be drivers next year, and then what investors can expect to see from this point forward, because we want to try to anticipate things that are likely to happen, especially when it comes to risks. We focus a lot on what the risks might be in various investments, and then more importantly, what the heck do you do about it? And I'll pause occasionally, Stephanie, and see if either of you have questions you want me to go down that path. And I've got as much time as you want. So let's go ahead and kick this off. So driver in the market right now should not be a surprise. It's Fed policy. And I've been saying for a while, it's less about what the Fed does and more about what the Fed says. We've known for a while now that the Fed's done raising rates. What we didn't know is when the Fed is going to start changing their stance on future state of rates. 2 meetings ago, they came out and they had higher long-term Fed funds rates, meaning they expect cash rates to stay higher substantially longer than the markets did. And we needed a change in position by the Fed. And the reason the Fed thought rates were going to stay higher for longer is because inflation has been kind of sticky. Now it's been coming down. The trend and the direction of that trend has been very, very good, but it's still higher than it needs to be. We're probably going to finish this year, call it 3 to 4% inflation for the year at the core level. Next year, probably finish closer to 3%, maybe a little bit below 3, unless something changes. And what we saw happen from the Fed is they didn't say they're done, but they came out now with their dot plot and said this coming year in 2024, they expect rates to go down 3 times, meaning if they cut interest rates by 0.25% or 25 basis points, they're likely to do that 3 times. Now, they didn't say when. And here's the whole thing. We all know rates are going down in the future. What we don't know is how fast and when. There are 2 scenarios that we've been talking about. There's the hard landing and the soft landing scenario. The hard landing is what normally happens when the Fed raises interest rates a lot. And that's where we see the impact of higher interest rates causes the economy to contract, causes the job markets to crash, causes the equity markets to pull back, and causes bond yields to fall. These are all things that are normal when the Fed raises interest rates as aggressively as they have. That's a hard landing. We also refer to that as a recession. These are very normal. We've had 7 of them. We've had 7 cycles where the Fed has raised interest rates and caused the economy to contract. It's very normal. However, the scenario that we haven't talked about as much is the soft landing scenario. The hard landing, the Fed is going to be forced to bring interest rates down fast because it's as if they're flying a plane and they were going up, 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 and all of a sudden they slowed the engine down and now they reach stall speed. That's when they have to restart the engine. That means they have to bring interest rates down a lot. Well, in that environment, the Fed's going to cut interest rates fast and by a lot. Think about back when COVID happened. What did the Fed do? They cut a lot and they cut fast. They went all the way to zero extremely fast. That's a hard landing. They've done that every time they've raised interest rates by a lot. This time, this probability that we soft land, and soft landing is we land on the aircraft carrier so nicely, grab the hook, plane stops, everything's okay. The Fed has never done that before. Never done it before. It looks like that's the direction we're heading in. It looks like the economy slowed down enough to cause inflation to come down. Remember, inflation, not negative, it's the rate of change. So it stopped going up fast. It's still going up. It's not going up as fast. Remember, we can afford 2 to 3% inflation, and it's okay. We can't afford 4 to 5% inflation because it causes problems. And it looks like we're getting closer to that 3% inflation now. And if the Fed does manage a soft landing, meaning no recession, maybe you get a little bit of a contraction, maybe not, it means the Fed can lower interest rates very slowly over time for a good reason. We've never seen this before, by the way. This is new. This is new. This is the person knocking on your office and saying, "Hey, this time it's different." And you're like, "No, it's never been different." So far, it's kind of proving to be different. We want to be aware of that. If in fact the Fed is able to orchestrate a soft landing and they start lowering interest rates very slowly, everybody wins. Stocks win, bonds win. The only people that lose are cash, because cash rates are going to come down, but they're going to come down slowly. The dollar comes down slowly. All these things happen slowly if the Fed orchestrates a soft landing. Hard landings, stocks get beat up, bonds rally, cash gets beat up, dollar probably strengthens because it's strength and people are going to buy US assets in a bad market. So now what we want to know is, if it's a soft landing, what does the rest of the world look like? So the ECB is meeting tomorrow. ECB is probably going to follow the Fed. The ECB didn't raise rates as much as the US. Therefore, the European Central Bank is concerned that if they start to lower interest rates, they're going to reignite inflation. They have a harder time fighting inflation because it's multiple economies under a single currency, and it's problematic. The other problem that Europe has, and this includes the UK, is their mortgages are all tied to variable rates. As rates have gone up, mortgages have gone up, and people's mortgages have increased by 100% in many cases. And that's eating into their spending. So they have less money to spend now. Therefore, Europe did not raise interest rates as much as the US did. I would expect the European Central Bank and then later the Bank of England to follow suit, not necessarily to lower rates, but to basically say, we're done. We think we're heading in the right direction. And I think because of that, you end up getting stocks around the world doing well and bonds around the world doing well. And we have a stock market here in the US that has returned more than 22% this year for large caps. Small caps, much worse, right? Small caps haven't participated as much because they are very rate sensitive. Therefore, if 2024, this is part of the outlook, if the market believes rates are going to be coming down in 2024, that benefits smaller companies because their debt refinance that really happens in 2025, their debt refinance becomes more attractive. And you should see next year, warning lights here, outlook, you should see a rally in small caps and mid caps next year relative to large caps because of their interest rate sensitivity. You should also see a rally in European stocks because they tend to be much more interest rate sensitive. What do you do as an investor? Well, you either want to own more small caps and mid caps, or you want to own more European stocks. Our preference is own more US small caps and mid caps because they tend to be better uses of capital as opposed to European companies, which tend to be a little slower growth, a little more tied to sovereign issues. So we have basically decided we're going to stay out of Europe as much as we can, stay out of Asia as much as we can, and we're going to bring that money to the US, own more US assets, but make sure you own ample amount in US small caps and mid caps so that when that economic data starts to turn and you start to see things working, small caps and mid caps should theoretically perform the best. And that's kind of what we're banking on. We own a lot of US, we own a lot of large cap, but we tend to own a lot more small cap and mid cap than most. And the market today is about 12 to 13% small caps and mid caps. We own about twice that because we think those are set to do much better in 2024 and 2025 as the pressure of higher interest rates and decelerating inflation come to play. Let me pause there before I start going on a diatribe in any other direction. And I guess, Brandon or Stephanie, are there questions that I can answer that will be helpful?
I have a question as it relates to the Fed cutting interest rates. So what I've heard is that when the Fed does start cutting interest rates, initially the market will rally, but there's usually a reason. And you explain the soft versus the hard landing. What your preference is obviously for the soft landing, which has never happened. So if you're wrong and it's the hard landing and we have small caps and mid caps and you're wrong, then what? We just change our view at AMS or?
Yeah, here's the thing. What I haven't mentioned is what our current positioning is. Today, we are overweight US fixed income. We have more bonds today than we would normally hold. If you think about a balanced investor, we would normally hold about 35% of the assets in bonds. Today, we hold 37%. So we're running a couple hundred basis points higher in US high quality bonds, treasuries. And we're underweight equity because the scenario that you just brought up is kind of the highest probability scenario. Like, let's assume that we're not going to live in a world with rainbows and unicorns. We might get rainbows, but we're not going to get the unicorns. Therefore, the thing that benefits you the most if something breaks is bond. We started doing this this year. We started adding dedicated exposure to intermediate to longer, but not real long, US Treasury exposure, because I don't want to be the person that comes out and says, this time it's different. So we ended up basically doing two trades: sell some stocks and buy some treasuries. But in addition to that, make sure the stocks that we still own have enough small and mid cap exposure that if the markets do rally, like today, investors benefit from that. Because I would much rather not be wrong than be right. So you kind of hedge some of these trades, and you hedge them based on the probability of being wrong, not the probability of being right. And the abundance of data basically said the economy is likely to contract. And I would much rather us be meeting next year and saying, yeah, the equity markets were up another 25%. That was great. The bond markets were up 5, 6, 7, whatever the number is, which is also good. It cost us a little bit because we had more bonds than we would normally hold, but portfolios are doing great. That's a better conversation than why did you tee up small caps and mid caps and the markets dropped 25%.
Yeah, and I think that's a good point, Nick, because, a question we get from a lot of our clients, we're buy and hold. Stephanie and I plan for our clients. We build a big plan and we put them in a portfolio that suits where they're trying to get to. And the last 2 years have been difficult conversations with market up, market down, rates continuing to go up. The ballast in their portfolio is working against them. So this reinforces there's smart people looking over the portfolio and playing the odds and making educated guesses with an emphasis on risk on their behalf. So
and it's a very, very important thing to understand. Everybody wants to make money, and it's always important to understand what's going to earn in the future. But it's also important to understand if something goes wrong, how much are investors likely to lose, and is that acceptable? Because some level of loss has to be acceptable, or else everybody would just own cash all the time. And it's understanding the dynamics of losses. 2 years ago, at the end of 2021, our position was bonds are likely to see the worst losses they've ever seen because rates were near zero and they were going to go up. Everybody knew rates were going to go up. It was the decision of how fast and when that we didn't know. So you have to project some of those things. And we projected an 8 to a 9% loss in the bond market for 2022. And we did see the worst bond market ever. It was just worse than what we thought. And you can be absolutely right in this business and still be wrong. And it's understanding the dynamics of what's going to drive risk. So I look at risk today and I say, the risk in the bond market, well, there isn't any. Like, I can't come up with a scenario that somebody loses money in high quality bonds in 2024. Because the only way they lose money is if the Fed changes direction and raises rates more than 100 basis points higher or another 4 times. And that's just not in the cards.
There are people out there on CNBC who are saying we're going to 6-7%, like Jamie Dimon.
But once again, Jamie Dimon says things that benefits Bank of America. Or JP Morgan Bank, sorry, not Bank of America. He says things that benefits his bank, not because he's an investor looking at things. And look, I know Jamie-ish. He's kind of friends of the program. We meet on occasion, and he's an extremely intelligent guy, but everything he says and does is about JP Morgan. And he says things for a reason. 7% interest rates benefits the biggest bank in, well, the world just about. So between them and Bank of America, I think they control 70 to 80% of consumer cash flow. So there's a lot in what he says that benefits him. So don't listen to what he says, listen to what he does. He's buying JP Morgan stock and a lot of it. Why? Because he knows that he's going to make money if rates continue to go up. I look at it from, we talk about last year being a difficult year. For the last 3 years, balanced investors, at the end of this year, a balanced investor is still going to earn close to double-digit returns, even given how bad last year was. And that's not terrible. We just happen to have made a lot of money, lost 15%, and then made a lot of money. And it's that volatility of returns that have been quite painful. And for your more conservative clients, it's very much out of character when your conservative clients are losing more money than their more aggressive clients. And we saw that in the first half of last year. Those things have kind of right-sized themselves. So the more aggressive accounts have returned this year, call it 17 to 20%, where the more conservative accounts have returned, call it 7 to 9%. That's more normal. You would expect that in this type of environment. Last year, you're trying to explain to somebody, yes, I know you're conservative. Yes, you actually lost more than somebody who's aggressive because the losses were incurred in the bond market where you own more. We're kind of away from that now. And if we ever get into an environment where bond yields get back below 1%, we now have an understanding of possible risks that might be greater than what we originally were fathoming. And that's part of the risk process. The risk in the bond market is what's your yield today and what do you think your yield's going to be in the future? And we spend a lot of time working on that, and we usually get it much more accurate than anything else. We just struggle with the exactly when it's going to happen. For example, I can tell you the 10-year treasury is going to get to about 3%, but I can't tell you when. But knowing that, I want to own bonds because I'm going to get a good yield. Plus, we're going to get some appreciation on our bonds as we move from over 4% down to 3%. Might that happen next year? Sure. Might it happen in 2025? Maybe. 2026? Sure. It's going to happen. I just don't know how fast, and how fast depends on whether or not the economy recovers and reaccelerates or whether it decelerates and contracts.
Hey, Nick, I'd love to shift gears a little bit and talk about the elephant in the room, which is the political environment in the upcoming presidential election next year. Obviously, it has a huge impact on the markets as well. How are you and your team thinking about the impact of the coming campaigning and elections?
I would like to say the elections matter, but they don't. I mean, they matter for policy, but they don't matter to the markets. I've been doing this through a lot of election cycles, and every year we're always told this is the most important election ever. And I don't know what that means as a student of history and as somebody that has a political science degree amongst other degrees. I question people who tell us every 4 years that it's the most important election ever. I've never experienced a presidential election where I wasn't told it's the most important. I think history will determine which is the most important and which is not the most important. Here's what the markets care about. The markets care about whether or not we have a leadership change across the White House and across Congress. And the reason the markets care if there's a change in leadership, it's because there could be a change in rules, could be a change in laws. The markets prefer to have a mixed White House versus Congress, not because they think that is better for everybody. It's because nothing happens. When nothing happens, companies don't have to change. When you have to change because rules have changed, it becomes very difficult to manage that company. Therefore, even if you have the majority in Congress, you can't overcome a veto without having a much bigger majority. And there'll be a lot played on this election cycle. There'll be a lot played on, this is the best person ever, this is the worst person ever. And I don't know, let history judge that. Think about it from the market's perspective. What do companies care about? There are some issues that are going to be very important that I think are going to get overshadowed. One of the issues we're going to run into is we're refinancing government debt at a really high interest rate right now. And that's going to be problematic because our interest service has gone up dramatically. The amount of government revenue it now takes to service our debt has increased. And because of that, there's less money to go around. Well, if there's less money to go around, the government's going to have to borrow money to make up for it. Well, when does that come to a point that it's unsustainable? And you're going to have to slow spending or you're going to have to cut spending, but 70% of spending is guaranteed by law. So you can't change that without changing the law. To change a law, you have to have a majority and you have to have a White House on board. So there are all of these things that are going to have to be worked out. Debt limit is an issue, but it's the growth. It's not really the growth of our debt that has me worried. It's the growth of our servicing of the debt. The size of the debt doesn't matter. It's how much of the revenue that we're collecting is going to pay that debt. And just interest payments, by the way, not even principal payments, because we just roll it over. It's the interest payments that have been growing pretty rapidly. And it's hard to have a very intelligent discussion on the topic because it turns into a political discussion, but it is something that's going to have to be resolved. And it's going to cost people their jobs, meaning they're not going to get reelected because nobody wants to see, cut this, don't cut that. But something's going to get cut. Something's, either taxes have to go up or spending has to come down or both. And you're probably going to get both. And, one party is very opposed to one and one party is very opposed to the other. And you lack some of that supermajority in the center that tends to compromise. And I think because of that, that'll probably be the more heated debate. To me, everything other than that is more like when you watch CNBC and you think to yourself, what are these people talking about?
Fair enough. So, if the political landscape isn't the thing that keeps you up at night or that feels like the biggest potential red herring, what are kind of the wild cards out there that could impact your view and the markets going forward that doesn't fit into what we've discussed today?
We need to watch earnings. Right? Company earnings are very important, and we're not spending enough time as an industry talking about the importance of what's likely to happen next year and is that going to change? I'll give you an example. 3 months ago, the expectation was that the US was going to grow its earnings by 11 to 12%. By the way, that's actually a normal number. 10 to 12% is pretty normal. This year we grew by 0. Earnings grew by 0, which meant the entire return in the market was because multiples expanded. That's normal too. We see multiples expand and then earnings catch up. That's typically what happens. So next year, expectations of earnings growth of 12%, that hasn't changed in 3 months. So we've had 3 months now in a row that either hasn't gone down or hasn't gone up. What I'm concerned with is that the expectation for small cap earnings for next year have been coming down because analysts have been baking in the idea of rates are going to stay higher for longer. So I'm watching analyst coverage to see if those expectations start to come back up again now that we're seeing some softening of rates. That's what I'm paying attention to. Are expectations for earnings consistently improving? And what are we paying for those expectations? Right now, markets aren't expensive. They're just not cheap. The only markets that's cheap are small caps, but small caps are cheap because, well, they're risky. They're very sensitive to what's happening in the rates market. And we need to be clear that interest rates are on their way back down before we start to see small caps and mid caps benefit from that. We're also seeing the international markets. And when I say the international markets, there's developed and there's emerging. Emerging is a gamble because you just don't know what they're going to do. It's China, India, South Korea, Taiwan, Brazil. It's a crapshoot. We tend to have a very de minimis position in emerging markets because the data is somewhat suspect. If you look at the developed markets, you're talking 5% earnings growth next year. That's awful. But they've earned the right to be cheap. People say international is going to outperform because it's cheap. Well, it's always cheap because it's earned the right to be cheap. You need to have higher profitability, higher margins, and higher growth metrics overseas before you can start getting excited about shifting US assets to overseas. So those are some of the things that I'm really paying attention to. Entertainment, look, playoffs are coming up for football, right? That's more entertaining than what I see on CNBC. Remember, don't trust talking heads because they don't manage money.
Well, the Longhorns are going to take it home anyway.
I don't know. I mean, I've really, look, I was in Austin recently. I was in Austin after Texas beat Alabama. I was like, man, what a great victory. And that victory is what got Texas into the bowl or into the playoffs. But I think they're going to get their butts whooped. It's not that I'm hoping they will. I'm looking at the competition going, man, I don't know.
I think it's going to be a lot of fun. And I think the two teams that got left out, that's going to be a heck of a game too. But as a
They might
two times Longhorn, I can't resist a little plug.
They might boycott that game. My eldest child graduated from FSU and she's constantly complaining. I said, the team's not very good. I'm sorry they went 13-0, but they won the last two games on a backup and a backup of the backup and couldn't hardly score a point. So, let's not get overly enthusiastic. I think Georgia could have won the whole thing if they got in. Michigan has shown that they can't win a big game when it counts, except against Ohio State. I mean, I don't know what's going on with Harbaugh there. Maybe they just haven't spied on enough SEC teams, but that was meant to be
There's
fun.
still time. Well, Nick, I love how you're stirring up controversy at the end of the call.
Yeah, you should have seen me in Houston earlier last quarter when I said, so let me get this straight. Houston, do you root for the Astros even though you know they cheated? You still root for them? Didn't quite get booed, but it came close. As a Tampa Bay Rays season ticket holder, I have to give it to the Astros every chance I get because they've won the big one and we haven't. We've been there twice and lost both times. So darn Rays.
Well, somebody's spent a long time in, pardon me, who spent a long time in Texas. It's a very bad form to to go against a Texas team when you're actually physically in Texas.
Yeah, it feels like a line out of The Princess Bride. Is there anything else that you can think of that your clients are asking you that you would like me to give you what thoughts on?
The only one I hate to even bring it up is gold, and it doesn't come up that often. And I know that your policy is you guys don't really own, metals, but in this environment, what do you tell those people who are, again, maybe they're watching a different channel to get this sort of news that they should be in gold, but they're out there and they're doing it?
Yeah, look, I'll tell you, commodities in general have been a pretty bad investment for people. I don't know what the returns of gold look like. I don't really follow it, but I do know that the markets have outperformed gold over time by a lot.
Mm-hmm.
And
at lower volatility.
The only person I know personally that loves gold is my wife. I just refuse to give it to her anymore. She just doesn't wear it enough to make it worth it.
Nick, I'm sorry. I'm sorry to interrupt the answer to my own question, but I think where we come from, again, we focus on our clients' risk tolerance and their ability to meet their goals. So when they hear something on the news, and then if they tune in and hear somebody like you talk and understand the resources you have and the team that you work with and how you approach risk versus owning gold to offset it. We sometimes people don't want to hear it, and maybe they're just not investors. To your point, maybe some people just can't take the risk. But
yeah, I get it. The problem that I run into with things like gold or commodities in general is they don't do anything. They don't do anything. I can value a stock because I can look at how much cash it earns. I look at the amount of dividends it pays and grows. I look at the retained earnings. I look at all these things. Like say, this company is growing as an entity. I look at gold. I'm like, I don't know what it does. I look at oil. I mean, it's used in production, except in California. I think it's outlawed in California now, or it's going to be. But you can't value it. And that's a problem for me. Not only can I not value it, I can't put a risk on it. I don't know what the risk is. And everything else, I've got a pretty good idea of what expectations we should have for returns. I can tell you in 2024, my expectation is that I am 95% confident that bonds return somewhere between negative 0.5 and a positive 12%. And I got the math to support it. I'm 95% confident that's what's going to happen. I have no idea what gold's going to do, and I can't even give you a confidence interval around it. It would be so wide that it would be ludicrous. And those are some of the issues. And I know the risks of owning bonds versus the risks of owning stocks versus the risks of owning cash. And these are things that we know and that we can do a better job of managing. And I can even tell you what I think is going to happen next year. I think yields come down. I think they come down slowly. I think bonds perform very well for bonds. I think stocks can go sideways next year, especially those large mega cap stocks, because there's a little bit of catch up that needs to take place from the price movements we've seen. We need fundamentals to catch up, but we should see a resurgence in small, mid caps, and maybe even foreign stocks, because the dollar is likely to come down a little bit next year, because that's what happens when it's a risk on environment instead of a risk off environment. Risk on, people sell the dollar. They don't want to own the dollar, which favors foreign securities. So these are all things that I can actually look at the data and forecast it and come up with expectations. Some of the other things, I just have a hard time doing that. And I'm always a fan of if I can't do it, then I'm just going to stay away from it. Doesn't mean that it's not going to work for people. It just means I can't understand it.
Well, it speaks to the
That's a
value
good
of a core investment portfolio versus something that you might choose to speculate on with a small piece of your net worth if it's something that's intriguing for you. So you want to be able to achieve your plan. So you get yourself set up in a core portfolio that meets those objectives.
Look, funny story. My last story, I promise, but it's a funny story. We always look at what the next thing is that people are talking about. You know, a while ago it was a cryptocurrency, and I'm like, I can't explain it. I have no idea what it is. I'm avoiding it. I'm not saying it's good or bad. It's just I have no idea. I got into an Uber driver's car the other day to take me to the airport. I was in Phoenix, Arizona. And the Uber driver asked me what I was doing. I let them know I was there speaking at a conference, and they asked me what kind of conference, and I told them investment. He then tried to sell me on his non-fungible token business model. And I said, that sounds fascinating, but I have no idea what you're talking about. And I ran. But there's always something out there that people have that they think is the next best thing. And I have yet to meet somebody that's lost money in Bitcoin. Everybody miraculously made money. You know, I got in and got out at the right time. And I'm like, well, it's down 60%. So somebody lost money somewhere. But we just tend to avoid those things that are A, unexplainable, B, that we can't map out the risks, and C, that you can't actually invest in a liquid way.
Yeah, excellent synopsis. Nick, you've been a wonderful resource to us, you and your team. And if anybody has any questions that they'd like us to pass on to Nick, Nick has always been very gracious about responding quickly and just like he did today in a wonderful manner. Thank you so much for your time today, Nick. And
Absolutely.
yeah, we appreciate it.
Thanks, Nick.
And you know, as for our clients and friends out there, please reach out to Brandon and me with any questions about anything involving a dollar sign along the way. And happy holidays to everybody. Thank you so much for being here today.
You bet.